As an income focused or income seeking or income oriented investor, the bread and butter of my investing strategy is really covered calls. So, covered calls or the covered call strategy is a zero risk income enhancing strategy where you give up potential share price upside, especially during a strong bull market, for more income right now. So, 2 months ago, guys, I released a video on a brand new covered call ETF from Hamilton ETFs, the enhanced multi sector covered call ETF. The stock symbol is HDIV, and of course, this is on the Canadian stock market. So I was super excited about this fund and still am, because this ETF is really the first of its kind in Canada, and in my opinion, it's a genius ETF. It's a perfect fit for investors, income investors like myself. It literally has the three most important things that I look for when I invest in a fund: high and sustainable yield, diversification, and stock quality. So I strongly suggest you check out my video from 2 months ago where I do a deep dive into this fund. In short, this ETF holds 7 covered call ETFs, all of which cover a different sector of the market. And on top of that, they apply 25% leverage to the fund to really enhance the yield. So they target an 8.5% annual dividend rate or distribution rate, which is really, really good, right? 8.5 a year. That's higher than the overall Canadian stock market. So this ETF, guys, basically has 7 covered call ETFs all in one fund. So let's go through them really, really quickly, one by one. ZWB has the big 6 Canadian banks. ZWU, the best utilities, telecom, and pipeline companies in North America. You have FLI, the biggest life insurance companies. NXF, the biggest energy producers in the world. HTA, the best tech companies. HHL, the best healthcare companies. And HEP, the biggest gold producers. So all blue chip stocks, leaders in their respective sectors, right? And boy, do I have a treat for you guys today. I was fortunate enough to speak with Robert Wessel last week. He is the co-founder and managing partner at Hamilton ETFs, and he was more than happy to have a sit down with me and answer all my questions on this brand new fund. So enjoy, guys. Thanks for doing this, for joining the call here. Rob, guys, is from Hamilton ETFs. So we're talking about the brand new HDIV fund here, of course. So we're lucky enough to have Rob join us and talk about this fund. So once again, thank you very much, Rob, for joining us. So we could start with the questions right away. So, Hamilton ETFs is really an ETF manager who specializes in the financial sector. So what gave you guys the idea to come up with HDIV, as only about 28% of it is actually allocated to financials?
Yeah. So first of all, thank you very much for inviting us to this YouTube channel. We really appreciate it.
My pleasure.
And maybe before I answer any questions, I should reference everybody to the disclaimer on our website, Hamilton ETFs /legal/. There's a general disclaimer for our firm and our funds. So to your question, Adrian, thank you very much. So it's true, we do financials, and our firm has offered ETFs for over 5 years, and they're all financials until we launched HDIV. Really, it's as simple as we actually just thought it was a good idea. Mm-hmm. And the second thing is it's not actively managed. It is, it's a product that we created. So I think you could loosely say it was in the financials, and that it was sort of wealth management. But and the other thing is it's very consistent with our shelf, or our products that we currently offer, which is, very rules-based, very heavy on lower beta underlying with a higher yield. And so this kind of fit with it. And we just thought it would kind of be a fun product.
Okay, great. Yeah, it's really, really an awesome product, especially for, my audience, my viewership. My channel is all about high income. So I was very excited when I saw HDIV. So the second question I have is really on the covered call strategy. What do you think about the covered call ETFs, or the covered call strategy in general? Do you feel it's becoming more popular because of our low interest rate environment here and very low bond yields? Yield is very hard to come by these days. Was that one of the factors that made you guys come up with this new product?
Yeah, well, first of all, there's no question that covered call strategies meet a need in the market. Otherwise,
yeah,
it wouldn't be such a huge category. So there's just there's a significant amount of AUM in covered call funds, both mutual funds and ETFs. So there's no question that they meet a need for investors, which is higher yield. That's one of the reasons why, like HDIV, most of them pay monthly distributions. You're also right that low interest rates is almost certainly one of the drivers, but it also it's more tax efficient. It does give long-term investors upside participation if you believe the market is going to achieve its historical returns, say over 5 or 10 year period. Then I think that people can feel more comfortable with that, and versus say fixed income where rates are, as you pointed out, extremely low.
Yeah. Yeah, I totally agree with that. I think it's a great product for this day and age. So in terms of actually making the fund or the composition of the fund, how did you guys come up with, or how did you choose which covered call ETFs should be part of HDIV, considering there's multiple covered call providers in Canada?
Yeah, so there's lots to this question. I would say the first thing we wanted to do was create a portfolio of covered call ETFs that had a sector mix that was broadly similar to the TSX 60. So that was kind of the first criteria, which was top down. Can we put together a portfolio that really kind of becomes like almost a synthetically created covered call version of the TSX 60? Inside that, we did have some criteria on which ETFs we chose, because obviously there's a lot of them. The first criteria, as you might guess, is we were looking for those with higher yields, i.e., the underlying managers had more active option strategies, because of course we're not doing the covered calls. We just assembled the portfolio.
Right.
We also looked for ETFs that were a bit older. They were more established, they were larger, they had an observable track record, and therefore they were very strong in the category. That was those were the key criteria in order to become one of the 7.
Okay. I just have to say, I love the diversification. I'm a big fan, and I tell my audience this all the time. Diversification is extremely important, so I have to give you props for the sheer amount of diversification in the fund. I love that, Canada is very financial and energy strong, but in there you added the healthcare, you added the technology, the gold, the life insurance, which supplements a lot of the Canadian market. So I really love that diversification.
Yeah, and actually to that point, we wanted a sector mix that was broadly similar to the TSX 60, but of course it doesn't have the same underlying. We don't have a massive position in Shopify. In fact, Shopify is barely in the underlying.
Right.
So we wanted the sector mix to be similar. Obviously, there's a significant number of positions underneath that within each fund. So it's extremely diversified to your point, not only by sector, but also by underlying position. So we don't have anywhere near the concentration that you would have in an individual Canadian ETF. Obviously, there's some other geographies in there, but that was the underlying idea. And we thought that there was space for that because, of course, the concentration within the TSX 60 can be quite significant.
Yeah. It was definitely a great idea that I could attest to. I was actually surprised by the data, or it's right there on the homepage of your website, where you're basically, because when you create a new fund, I'm assuming you got to create an index that goes with it, and you guys are in the last 5 years you actually compared this new index, which is basically HDIV, and you compare it to the TSX 60, which is an index that pretty much kind of like covers the whole. I say it's like represents the Canadian stock market, right? TSX 60, the 60 biggest players on the Canadian stock market. And basically what you guys are saying is that these covered call ETFs, or the combination of these 7 covered call ETFs, or HDIV, basically actually outperformed the TSX 60 in the last 5 years, and that's even before leverage. So to me, that actually proves really how good the covered call strategy is, and how good or the potential that this fund could have. What's your take on that?
Yeah, so here's where I have to emphasize that the index is the selective multi-sector covered call ETF index.
Right.
So it's not our index, and it is not HDIV's performance. It is the index is the returns on an equal weighted basis of the 7 ETFs that are in the fund, rebalanced in the same term. But It's not HDIV, and the returns are not HDIV, and the index does not include our fees. It does include the full management expense ratio of the constituent ETFs, but not our fees. In terms of the performance of the index, I think I wouldn't say it's only covered calls, because I think it really had more to do with the sector mix and how that had done. So obviously we can't, prior returns are not indicative of future returns, as everybody knows. But yeah, I mean, I think it's a function of the sector mix, the quality of the underlying managers and the ETFs, and obviously, as we talked about just a moment ago, it doesn't have the same position mix. So the underlying positions, did better on overall over the last 5 years than the TSX 60. But it's something like 150 positions or 200 underlying positions.
Yeah. Yeah, I mean, and like you said, you attested to the quality. I mean, if you actually break down the 7 funds and look what's inside those 7, it's all pretty much blue chip quality stocks, right? And that's always the underlying. I mean, I always tell people, when you're investing in an ETF, whatever you're investing in, always look at what the ETF is investing in, the underlying assets. And I mean, I could tell right away, doing a little bit of research, because I know most of these ETFs by heart, they're all pretty much blue chip quality stocks, right?
That's right.
What about, sorry, go ahead.
I was gonna say that was very, very important, that we had a higher yield, but that it was supported by a quality underlying.
That's what I always tell people: high yield, high quality. You can't start chasing yield with those smaller to mid cap stocks. I'd rather have the big blue chips and the higher yield with the covered calls. That's what I've been trying to preach all the time. So let's talk about the leverage. So you guys decided to slap on some modest leverage, 25% leverage on the fund. What gave you guys that idea? What's the premise behind that?
Yeah, so the key for us is, we always, before we ever say the word leverage, we always say modest leverage.
Right.
So it's only 25%. So it's not a lot. Basically, it's enough to make a difference, but not so much that it fundamentally alters, the risk profile in a way that that is significant. So the purpose of the leverage was, there was multiple objectives. The first one was, as you know, all things being equal, a portfolio that has covered calls won't do as well in a strong market than those that don't, because every now and again you get called away, and that can be a drag on returns in very, very strong markets. So the first objective of this modest leverage was really to mitigate that yield return trade-off that's inherent in covered calls. So that was very, very important. The other thing we wanted to do, and I know this will come up, for long-term investors, we also wanted the extra returns to essentially help pay for our fee. Right. Because we have a fee on top of the underlying, and if you're a long-term investor and you're going to hold this for 3 to 5 years, and the market follows historical returns, then the extra return you're going to get from this modest leverage is going to more than pay for the fee. And then the third thing is, we can borrow money much, much cheaper than your average retail investor. So we can borrow at institutional rates, which are a very, very small fraction of your average margin account. So there is definitely some efficiency by us adding leverage versus the individual investor trying to do it through their brokerage account.
Yeah, I get this question all the time. Your strategy seems really, really good to use margin. And I always say, well, I rather invest in funds that are leveraged already, because like you just said, the financial institutions will always get better, cheap money instead of me. I mean, as a retail investor, as an individual, always pay more in those margin accounts. Yes, rates have never been better, but you guys will definitely have a better yield. So I rather a lower yield. So I rather invest in a leverage fund instead of borrowing it or using margin myself. So that's a great point, right? That makes sense. So I think you spoke a little bit about the management fee, and a lot of questions I got, really the first questions I got about HDIV is regarding the management fee. So this is a fund that basically holds other funds. So how does the management fee, if you could just explain that real quick, how does it work? What kind of management fees are we looking at here?
Yeah, so there's no question that was the most common question we got too. So first things first, there's no question that the returns that we get from the underlying ETFs are after the fees charged by the underlying managers. So there's, that's pretty clear. And then we do charge our own 65 basis point management fee. Our all-in MER would probably likely be somewhere around 80 basis points. In terms of our own fee, we think it's supported by a number of variables. First of all, we did create and structure the ETF. We did do the portfolio management work around creating it. We do arrange the financing. We pay to administer the fund, and the fund does have its own expenses. So there's that. And then again, we hoped that people would look at the big picture, or what we thought was the big picture, which is here you have a fund on the day it was launched, with a targeted yield of 8.5%, with a good mix, a high quality underlying, with good potential returns at the same time, supported by this underlying leverage, which we thought or hope that over time, if you're a long-term investor and the markets go up, that leverage will be paid, will generate returns that will more than offset our fee. And so we were hoping that everybody would look at the big picture, but yes, there are fees in the underlying, and then we charge fees on top.
Yeah. I certainly always tell my audience, look at the big picture, and just always remember the most important thing. If you're like me, I'm a long-term buy and hold investor, where I'm looking, the primary focus for me is really the income and the distributions of HDIV, that 8.5% yield target, which I think is really, really great and fairly modest as well. Those distributions are all net of the management fees, correct? So
Absolutely.
It's not like a lot of newer investors, they think like they got to pay some sort of fee or it comes out of their account at the end of the year. So management fees are pretty much, I say, they're included in the fund. They're net of distributions, correct, right? So yeah, that's that's awesome. Yeah. So let's talk about the actual dividend policy. So and we already touched a little bit on it. We know the target is 8.5% and it's monthly. Something that I love. I love getting the income monthly instead of quarterly. So the 8.5%, is that based on, I'm assuming it's going to be based on the NAV of the fund, right? So is it going to stay permanent? Is it going to reset every 3 months or every 6 months, something like that? I mean, I'm assuming it's possible it will fluctuate based on what the NAV does, right?
Yeah, I mean, so yeah, you're correct. So the 8.5% targeted yield was on the day that the fund was launched.
Right.
So obviously, if the market goes up 30%, then the yield will fall. We are trying to, we are paying monthly. I think one thing we are striving for, and it's not really possible to be exact, but we want the yield to be supported by the distributions of the underlying fund. So if you look at the yield of HDIV, generally speaking, it should be pretty close to the average yield of the 7 underlying less our fee. Right. It's not going to be exact because you're not going to have a distribution of 0.1245678 cents. So there's going to be some rounding, and but generally speaking, we don't envision like a large structural grind where the underlying yield X and then we pay X plus 300 basis points because we think people want to see a higher posted yield. This was designed to basically be the average of the underlying less our fee.
Right. Okay.
Divided up and paid monthly.
Yeah. When you say grind, I'm assuming you're referring to that term grinding, where you're eroding the fund. So this is something you're not planning on doing, right? Eroding the fund, and keeping that dividend similar and in parallel to what the covered call ETFs inside the fund are doing.
Yeah, I mean, and I mean, there's no question. There's an awful lot of funds where the underlying securities might yield X, and the manager decides to pay out X plus 300 basis points because it shows a higher yield, and therefore they hope to raise more money. But of course, all you're doing with the increment is just giving people their money back.
Right, return of capital, income, exactly. Or bad rock. There's
correct.
There's good rock. There's bad. This is bad rock because you're actually taking away from the NAV.
Correct. So that's an important distinction.
Right. Yeah, and I think that's where I think that leverage is really, really smart, because it really helps to get that yield a bit higher, right, at that 8.5%. So I think it's really, really smart.
Yeah, and I should also say, I'm sorry, I neglected to say in the earlier question, there's no question that leverage also works the other way.
Yes.
So if the market falls or the underlying fall 10%, then this will fall probably somewhere around 12.5%.
Yeah, 25% more.
And maybe a little bit more, but this is why we always emphasize for long-term investors. Yes. But in terms of the distribution, we think that it's a very big positive that the distribution is divided between these 7 sector ETFs. So if one of them does, for example, reduce its distribution, that has less of an impact on the holders of HDIV than it would be if it was the holder of that
That
particular
particular
ETF.
fund.
So
Yes.
we do think we've diversified. I mean, not only diversified by position and by sector, but we've also helped insulate the fund from a change in dividend policy from the underlying.
Yes. Yes.
Because most people know, and I'm sure you've spoken to your audience, which is sector ETFs, because they're less diversified, can have more volatility, and higher volatility might be able to support higher options premium income, and therefore a higher distribution. And so we're hoping that by having 7 of these ETFs underneath, that should one of them change its distribution policy in a meaningful way, it gets, the impact of that gets divided by 7.
Yeah, and this is why I really love this fund, the sector diversification. I always tell everyone, the more diversified you are across the board, the more you balance out, because there's always some sectors that, sectors tend to follow each other. That's pretty much right on the homepage of your website. You see the financial sector kind of tend to follow, each other. So if, for example, in HDIV right now, I could think right off the bat that, the energy one, the bank one is doing really, really well, but maybe a little, the gold one is suffering a little bit. So by having that, like you said, sector diversification, it helps bring stability to the fund. So I really, really love that part about the fund.
Actually, I would even add one other comment.
Yes.
Which is it's actually quite interesting. If you take so volatility is measured by portfolio managers as the standard deviation of returns. So if you take the standard deviation of returns of each of the underlying, you take the average of that, by putting it together, obviously you get a big diversification benefit, and that benefit or decline in volatility is actually greater than the increase in volatility that you get from adding modest leverage.
Interesting.
Interestingly enough. So in effect, in a high level, one could conclude that the diversification benefit by creating the portfolio, what we basically spent part of that in the form of higher leverage, but ultimately the standard deviation of the index, the selective index, is less, with times 1.25 is less than the average of the 7 ETFs underneath it.
Yeah. Okay. Very interesting. Very interesting. Cool. Yeah. Awesome stuff. One question I had is, this might not be super important, but I see that Horizons ETF. So Horizons ETF is the administrator of the fund. That's what it says on your website.
Mm-hmm.
So what exactly
Right.
does that mean?
Yeah, so that's an excellent question. We do get that from time to time. So our current ETF AUM is approaching 900 million. But when we launched our first ETF, our AUM was very, very low. And in fact, for ETFs, it starts with 0. We didn't have any experience in operations and how to administer the back office of ETFs, which are much more complicated than mutual funds, for example. So we engaged Horizons, a fantastic company. They do all of our back office tasks. They do things like fund accounting and all the stuff that we didn't have any experience on, and we didn't want to try to, I guess, for lack of a better phrase, we didn't want to do, and because we had no experience in it. So Horizons has, a very, very old firm. They're one of the longest or oldest, I should say, ETF managers, deep operational experience, and we benefit tremendously from their expertise, and that is an excellent company.
Yeah, they're awesome because I've told my audiences several times, their parent company is Murray Asset Management.
That's right.
And their brother company is Global X, and Global
Correct.
X has some of the biggest or it has the biggest covered call fund, QYLD, in the States. So these guys are really what I like to call covered call experts. So I was quite happy when I saw them, because right away I said, well, it's because they're covered call experts. So that was
they're just experts on ETFs, period. So they're very, very that's a blue chip firm for sure.
Yeah. Okay, perfect. Thanks for that. And last question I have is about the tax efficiency. So not many people know this, especially newer investors, but capital gains and return of capital is much more tax efficient than eligible dividends. So, covered call ETFs usually give a lot of capital gains and return of capital, because all those covered call options, that's not dividend income, that's capital gains income. So I'm assuming HDIV is going to be very, very tax efficient.
So the taxation of HDIV will basically be the amalgam of the 7 underlying
The
ETFs.
7, yeah.
With the exception of there will be some interest expense applied at our level.
Right.
So it's basically exactly the same. It'll be the average of the 7, adjusted for the weights and the minor variations that happen during the year. And then we'll add, the tax slips will include interest expense from the margin facility. Right. But yes, it is just as tax efficient as generic covered call ETF.
So this is really something great, and people shouldn't be bothered by putting this in their non-registered account, because when it comes to TFSA, RRSPs, taxes are all deferred. TFSA has no taxes. RSP, it's nothing burger until later on. But people are always, I get a lot of concerns all the time about taxes. How much do you pay in taxes? So this is actually a very tax efficient fund. It's more tax efficient than owning, let's say, Bell Canada or all the Canadian blue chips, because that's all dividend income, which is taxed. Not as good as capital gains and ROC income. So thanks for clearing that up. So Rob, listen, I really appreciate it. I don't have any further questions. If you want to add something, feel free. I mean, go ahead. All my questions were answered.
We really appreciate the audience. I guess if I was to add anything, I would recommend people visit our website.
Yes, of course.
Those who have financial services exposure, we have an awful lot of commentary, and we have a modestly levered Canadian bank ETF as well, which is extremely popular. But we, myself and behalf of all my partners, we really appreciate the invitation to speak to your audience.
It's an absolute pleasure for me. I thank you for coming on, and hopefully we'll do something in the future. We'll track the new products that come out, and we'll keep in touch.
Okay, thank you so much.
Thanks, Rob. Really appreciate it.
So I hope you enjoyed the interview, guys. It's the first time I have a fund manager come on the channel and do a Q&A with me, and I'm definitely planning on doing more. So it's super exciting for me because I could bring you guys some really great content here, and hopefully it gives you the confidence to invest, as this brings really a sense of legitimacy to my income-focused investing style, which isn't really mainstream yet, right? So Rob was the one who actually reached out to me, believe it or not, because once my video came out on HDIV, the one of 2 months ago, they saw a big increase of traffic on their website, and they determined that it was because of my video. So that's great stuff. So it's a win-win all around, guys, and hopefully I'll be able to have more interviews like this in the future. So I said it before and I'll say it again, this new fund is really amazing. It's exciting. It's really a dream come true for income-focused investors like myself. So make sure you check out Hamilton's website for the complete details on this ETF and how it works, as well as their other ETFs. Like Rob mentioned at the end of the interview, they also have a very popular ETF called HCAL, which invests in the big Canadian banks. So just like HDIV, it uses 25% modest leverage to really boost the yield of the fund. So it's really one of the best ways to get exposure to the big Canadian banks. And I got another video lined up for you guys on that topic. I'll go over the best and my favorite funds when it comes to exposure to the big Canadian banks, and HCAL will certainly be one of them. So as always, please support me. Please support this channel by hitting that like button. I would really appreciate it. It helps the channel grow. So please hit that like button, and make sure you're subscribed as well so you don't miss out on my future content. And of course, guys, visit our website, passiveincomeinvesting.ca. That's where you could access a bunch of free tools and information, as well as access my digital product, the Ultimate DIY Investing Package. Version 3 just came out. I'm very excited about it. It has a lot of sample portfolios for Canadians, for Americans. So I've been getting a lot of great feedback about it, so I really appreciate it. I know you guys love those sample portfolios. Also on my website, you could book a one-on-one private consultation with me personally via Zoom if you want me to check out your portfolio, help you to build a new portfolio, transition to an income portfolio. That's my specialty, as well as ask me a million questions. I'll do my best to help you. So right now I'm completely sold out for October. All appointments have been booked. So I'll let you guys know via my Facebook page, my Facebook group rather, when the November appointments will open up. They will open up in the next couple of weeks, so stay tuned for that. And like I mentioned, Facebook. So we have a Facebook group that keeps growing, over 4,000 members. So make sure to join us there, and follow us on Instagram as well if you use that social media platform. It's all content designed to help you on your investing journey, and you could follow our journey as well, to really give you that confidence to invest. Our mission, the mission of this channel, guys, will always remain the same. It's to help everyday normal working people invest on their own, right? To become DIY investors, to invest so they could enhance their income and achieve maximum passive income, so they could eventually become financially free, financially independent like us, because that's the most important thing in life. So with that, take care, guys, stay safe, and see you next time.